G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. Today, we've got two heavyweights, and I don't mean that in terms of their weight class. I'm talking about industry, the accolades that they've received, but also the knowledge that they bring to the table. I am super excited for this episode. Welcome on, Cate Bakos and Peter Wargent. How you both doing?
Yeah, really good. Great to be chatting with you again. It's lovely to be alongside Pete. I was just saying before we started recording, I don't get to see him because he's on the other side of the globe right now. But
thanks for joining us.
A labour of love, hasn't it, Pete?
Yeah, doing the rounds, and we've done a bit of promo over the last week or two. Been good.
Well, this is the pointy end because you've done all the hard work with putting together the book, and we're gonna go through the book. So, if you're unfamiliar, the Buy Right approach to property investing is the book that you've just released, and we want to go through this in a lot more detail because I feel like what you've put pen to paper on and the way that we're talking about the approach to property investing, it's going to shift a little bit of people's thinking, and that takes some time for people to get their own head around and maybe their own biases out of the way as well. So that's what we're going to go through as well. But if you've been living under a rock and you don't know who these two industry legends are, let me just take you through. So Cate Bakos has been around. Cate, I'm not going to give you look like you just stepped out of school, mate. It's like 20 years experience. This is ridiculous.
It's the filter.
Yeah, mate. I need to get that filter, whatever it is. But you're part of the property trio, which is an awesome podcast as well. So I want to say kudos for what you're doing there with two great guys, David and Mike as well. And I mean, you've been around for quite some time and captain of your industry, isn't it?
Yeah, I've had a lot of fun in this industry. It's been I went into the property industry 20 years ago, so 2 decades.
Yeah, nice. And I saw that your daughter is now entering the property market. Is that correct?
Nearly. She's 17. So we've just got to wait till she turns 18 so she can legally sign a contract.
What a problem that is, isn't it? She's got to wait a year.
I know. It's pretty awesome. I'm very proud of her. I've always thought, if she could do this before she's 21, it would be great. But she got a fire in her belly and she's been contributing some of her savings to her Vanguard account, and Vanguard has done quite well.
How awesome is that? I feel like that's just gonna blow that open for young Australians when you go, look, if an 18-year-old can do it, with obviously your knowledge and using that to her benefit as well, but she has to want it herself, and I feel like that is gonna change the conversation for a lot of younger Australians. So well done. And Pete, I know you got your podcast as well alongside the great Chris Bates and the crew there as well, the Australian Property Podcast, which I know goes absolutely gangbusters. So thanks for joining us, mate. Appreciate it.
A pleasure. Yeah, great to be on, and looking forward to the chat.
Awesome. And, mate, you said, I read your bio and you're a cricket tragic, it says here, mate. So I think we'll just park the whole property conversation and go straight into cricket, which will do me fine. But, mate...
just don't mention the Ashes. It hasn't been a great haul in recent times, but next time we'll get our revenge, hopefully.
Mate, it's not short of some interesting... Did you watch the one on Prime, the Test series? Have you bought yourself
I did, yeah. And also the T20 World Cup's on right now, and Australia already beating England in that as well. So, it's been interesting times, but it's always fun being a pond down under when the cricket's on.
Oh, I can imagine. Good times. So a little bit, I guess if people aren't familiar with your journey, in a nutshell, the Cate Bakos story, you've been in property for some time, buyer's agent, helping a lot of, buyer's agents down in Melbourne. What else do people need to know about yourself, Cate?
Oh, wow. I'm an investor.
Yep.
So I, really love all of that. But, personally, there's a bit more to Cate Bakos. So as you just mentioned, I'm a mama, and I moved to Melbourne's inner west, about 12 years ago. I was buying for clients over here and just got the green-eyed monster. I was so jealous. I loved it. I just felt like I could carve a life here, and we've done so. So packed the family up and moved across the bridge, and haven't looked back.
Beautiful.
So people have asked me often, what do you do in your spare time? I don't have a lot of spare time, but I take photos and I play the piano.
There you go. Nice one. And Pete, we were talking before, you're living in a beautiful part of the world as well, up in Noosa, working on your 10 up there.
I am. Yeah, so I originally came to Australia, funnily enough, to play cricket. I knew a lot of Aussies from playing what they call Premier League cricket in the UK, and I knew quite a few players from the Waverley Club in Sydney, which is basically at the top of Bondi Road there. Mm-hmm. And lot of them were saying, you should come over and play a season down in Australia. And I did that as a young backpacker effectively. So I was working during the week and then playing cricket at every available opportunity. And it was kind of at the end of that 12-month visa when I was like, oh, you know what, I should probably have a look at coming back. Pretty good part of the world to live. And I guess my professional career was as a chartered accountant, which got me on the skill shortage visas, or the 457 visas, I think it was. I can't remember the name now, but basically the skilled visa application, and that got me in, moved to Sydney. So I was originally in one of the big four accounting firms, and then later on had a desire to be an entrepreneur, and property was the way that came about. But yeah, you're right. For the past decade or so, we've been up in southeast Queensland since we had kids. So been quite a journey, and good part of the world.
Awesome, mate. Happy to hear. Lovely. I want to kind of zoom out a little bit and talk about the current property market. And I guess my big question here is, does it surprise you? I mean, when we talk about, and we were saying before about Brisbane and how it's just kind of pipped Melbourne for median, second to Sydney median house price. And you got Perth, which is going absolutely gangbusters at the moment, and Adelaide has done quite well. But Melbourne seems to be falling really far behind. So I just want to get your read and your view of the world and how it's kind of performing. And is this what you would have predicted maybe 6, 12 months ago, or does it surprise you a little bit what's going on?
I've been surprised, yeah. So I've actually been travelling around a bit over the past couple of months. So spent a bit of time at the Gold Coast, had a week in Perth, which is the first time I've been able to get over to WA for years, actually, with all the various restrictions, and obviously we work full time as a buyer's agency in Brisbane. If you actually zoom out even further, if you think back to the early part of 2020 with all of the uncertainty, and then the borders were closed, you had no immigration. A lot of people said that would tank the market, and ultimately it didn't. So it's been surprising from that perspective. But yeah, I think for sure, if you went back, let's say 18, 21 months ago, when futures markets started pricing for a cash rate, I think at the time it was about 3.25%. And at the time I was thinking, gee, if we do get to that point, that probably will have quite a handbrake effect on the market. And as it's turned out, the cash rate target's now 4.35%, and yet the market's still powering along. So yeah, it has been surprising. It's not surprising that there's a market cycle, but I think, as we'll probably come on to talk about, it's just the shortage of housing, and the supply hasn't kept pace with the snapback in immigration. So yeah, I think actually overall, yes, it has been surprisingly strong, and not just in Brisbane, across the regions as well.
Yeah. Kate, you're close to the action down in Melbourne. Does it surprise you that it's, I won't say poor performing,
so
but
disproportionate?
Yeah,
well, we've underperformed by a large margin. There's two parts to this question, Aaron. The first one is, has it surprised us that the market's gone gangbusters? And Pete's answered that perfectly. You would have thought that with higher interest rates that we might have seen buyer sentiment change, but people need housing, and we've seen in previous cycles that high interest rates don't spell limited spending. So that's a fair fee that a lot of people buy into. When we think about investors, we've seen a significant number of investors return. Those numbers are up, and the returns are pretty good, even though the holding costs are higher. And we've also seen first home buyers incentivised. So, you see after a horrible global event like the pandemic, things change up for people. Their individual housing situations change. We saw a lot of divorces through the pandemic. We're seeing a lot of people getting together now. When people get together, you often see, house sales, and then they combine forces and buy something together. And also, obviously, we've had record high population growth. So, it's not all a bad story when you just see one metric that freaks everyone out like interest rates. But the second question is about Melbourne. Am I surprised about Melbourne? Sort of. I'm an eternal optimist, and it's my home city, and I've got investments here. So, would I love to see it performing better? 100%. But we've had some pretty nasty headwinds, and we've had some pretty stupid political decisions and some hefty taxes that have freaked people out. And even if the taxes spook investors, you'll always have home buyers sitting on the sidelines saying, well, with the sentiment where it's at and all of these horrible things that investors are facing, will that have a downwards pressure on prices? And if it will, we don't want to buy in now. Everybody wants to time the market. So I'm not entirely shocked. What I am surprised by is just how much we've languished. But when I look at the change that I'd consider now versus 5 years ago, I've got a lot of Sydney-siders moving to Melbourne, particularly now that there's such a disparity in median values, and people are voting with their feet and they're saying, my city's really expensive, where else could I go? So for all of the people that are dealing with Melbourne and feeling sad about it underperforming, we're getting a few opportunistic buyers that are jumping onto it as well.
Yeah, interesting one. Yeah, I came down to Melbourne recently and I was surprised. It had because I always felt it was a really vibrant city and there was plenty going on and restaurants have been full and cafes. Came down, I felt like it was empty. And I'm like, I haven't seen this.
Really?
Yeah, I had a really different vibe on. That's what we said. Is it our view that we maybe are a little bit more aware that it's not an economic powerhouse like what it has been the last few years, and is it just those headwinds that are nudging it back, or was it just that weekend? I don't know, but it just seems
must be just that weekend. I want to know your secret. I struggle to get bookings at restaurants. The city it's bounced back from a fun and laughter and food and drink point of view, and I think that there's a lot going on, but a lot of businesses really suffered, and we've seen a lot of change particularly in the hospitality industry.
Yeah, it's very evident, isn't it, in the hospitality industry? I think you can see it kind of holding on by a thread. Yeah, thanks very much. Perth as a market, I mean, Pete, you said you were over there, and again, being on the ground, you're probably seeing it a lot. I mean, we see it a little bit in sometimes the valuation reports where the valuers are kind of off the cuff comment going, there's a lot of like investors flooding in this market, and they're raising their own red flags there as well. Because there was a NAB report that came out saying they're going to see like 20% growth in the next 18 months. So they're optimistic, but what are your views of the Perth market at the moment?
Yeah, the most interesting thing when I was there, bearing in mind that Perth has been the most cyclical market over the past 2 decades, I think I used to work in the mining industry years ago, and I think when there was the early years of the mining boom, and then we got towards the end of the cycle in Perth, you could see the construction coming. There was a lot of projects coming out of the ground, apartments, which are not the main sort of dwelling type really in Western Australia, townhouses, all of that kind of thing. The thing that's really evident now is that despite the rental vacancy rate being 0.4% or something, yes, there are houses being built out in suburbia, but when you look around, there's no units getting out of the ground at all. So there's always a risk if you get into a cycle too late, and a lot of people are jumping in now after a dozen years of not very much. But I do think the cycle will continue for quite a while, for the simple reason that the supply is just not being delivered. And if you think about certainly the medium density stock, that tends to take a couple of years really to be delivered. I think houses are starting to pick up now. But there's quite a supply shortfall to be tackled. So I wouldn't be surprised if those growth figures are met. It's just you do need to be careful, though, buying in a frenzy, because we've certainly seen, I've got clients who've been upgrading in Perth, and they've found that, when they come to sell their property, it's selling before the first open sometimes, or selling off market. So it's a properly pumping part of the cycle. So I wouldn't be surprised if it keeps going for longer than people think, though.
Yeah, okay.
I'm with Pete, actually. I saw this really interesting chart that profiled each of the capital cities against the Australian average price, and where their median price or average price typically sits against the national average. And I know it's only one measure, but we've got Adelaide that's been going gangbusters for a long, long time, and Brisbane that's been performing really strongly as well. And they look overcooked by any measure when you're looking at this chart. Their historical differential is a lot wider now. It's that they're showing that they've had exceptional growth that's been outside of their historical norms. And Perth, you would expect to show something like that as well, but it's actually only just come back and reached parity. So I would argue that the Perth isn't done yet either. But one scary thing that I was looking at just in this month's data was old listings. So if you separate out new listings, all listings and old listings, older defined by 180 days plus, we've had an enormous uptake of those in Perth. Like, it's absolutely obliterated all of the other data nationally.
Wow.
So what that says is people are scrambling so hard in Perth, they're buying all of the old stock. And old doesn't necessarily mean bad, but usually there's a reason why something's been floating around for over 6 months on the market. And now we've seen enormous uptake. And that's always a signal of a FOMO market. And that can be dangerous when you're partaking in those buying conditions.
Thanks very much, Cate. I appreciate it. And I guess our view of the world is that we're always seeing people take action. So, if they're engaging a buyer's agent, that means they're highly engaged, they're highly motivated. When they're going to a broker, they're getting organized, for example. So we are very much at that pointy end where we're dealing with people that are ready to buy, transact, and take some action. When people are sitting on the outer, and they're probably some of the fringe conversations that the three of us may have, where people are waiting for this cycle to ease off. And I think, Pete, you might have alluded to it before, is that the only thing that can really change this is supply. But we're looking at all the supply metrics going, there just doesn't seem to be enough. So how does someone that's waiting for this cycle or potential slowdown or potential dip to get into the market, and we've talked about, in this previous episodes, the 18.6-year property cycle and different measures as well. But Pete, what's your read? We'll come to yourself come to yourself in a second, Cate, as well. But Pete, when you talk about the supply side, what are you seeing? Are you seeing enough to soak up the demand, or are you just saying, look, we're just going to be constantly playing catch up for the next 3 to 5 years?
Yeah, I think there's definitely a cycle when it comes to the housing supply. So I think at this point in the cycle, people they're looking for reasons. So they're looking at things like planning approvals, the planning system. There's issues around skilled migration and competition from infrastructure and all kinds of things. The main reason that supply is not being built is that prices aren't high enough for units. So the cost of construction has gone up maybe 50% for medium density projects since the start of the pandemic. And the gap between new and established properties is too wide, and it's just not really stacking up for developers. I think, though, if you accelerate, or if you look down the track, eventually, maybe in 2025, we'll see lower interest rates. I think generally prices will be rising and higher. And then eventually, there'll be a bit of a stabilization in the price of materials, a bit less competition maybe from mining and infrastructure. And eventually stuff starts to get built. But I think it will be a few years away. I think, though, when you go back through previous cycles, it's not so long ago, 7, 8 years ago, there were articles about the Brisbane oversupply. We're going to be worse than Ireland. It's going to crash the market. It was even in the Reserve Bank's financial stability review. The oversupply of housing is going to cause a systemic risk. Well, it's only 8 years ahead, and here we are talking about chronic shortage. So I do think there'll be more of a cycle than people actually appreciate at the moment. But the timing for that to be addressed, probably still 2027 or something like that, maybe a little bit earlier if things start getting built, but a bit of a way to go first, I think.
Absolutely. What's your thoughts, Cate?
Aaron, you asked about how people could time it, and there's a couple of answers to that. I'm not a massive fan of trying to time the market. I mean, it's great when things go your way, but when it's a long-term buy and hold, and it's a really clear decision and you've worked out your criteria, you've got to be prepared to ride these waves. And when you stand back and look at the big picture decades later, it's more of a straight line than a jaggedy one. But short story, though, to Pete's point, we've got a bit of a building crisis and materials are expensive, trades are expensive. I think the secret is to not worry so much about the market conditions in the location that you're wanting to buy into, particularly if it's a home, but to consider your land to asset ratio. So what I mean by that is don't get something brand new. Make sure that the inherent value isn't all tied up in your dwelling. You want to make sure that the dwelling is the smaller proportion of the value as opposed to the land. And that way you're insulating yourself somewhat from this issue that we're dealing with. Heightened building costs equals heightened dwelling cost. And ultimately, if you have a depreciating dwelling, then you could be losing money. And I think making sure that you're buying for the long term, that's really critical, because short-term ownership or tenure will always bite, particularly if you're dealing with a lower land to asset ratio.
I might just add to that if it's okay.
Yeah.
Obviously, part of what we've been doing over the past year is writing. And in the book, one of my favourite parts of the book is where Cate isolates a range of purchases over a long period of time. And she's bought properties when interest rates have been higher, when interest rates have been lower, when inflation's been up and inflation's been down. And yes, the market timing in the short term makes a difference, but the longer you own an asset, the less of a difference it makes. I think I think you could pick almost any year. If you went back through the past 2 decades, there would be always a reason in the market. There was the Banking Royal Commission, there was the global financial crisis, there was, oh goodness knows, like the amount of different things that were supposed to be an issue. But the longer your time horizon, then potentially the less that market timing matters. So yeah, I mean, obviously you want to time the market as best you can within reason, but as Cate said, some people are just looking to buy a first home. It's not necessarily always about investing either. So yeah, there's always going to be a reason not to buy, but if you've got a longer time horizon, that sometimes matters a bit less.
Cool. Thanks very much. I appreciate it. Cate, you mentioned before around, I'd be worried about the short term, that almost trading mindset, for example. What time period are you calling short term?
Ooh, I won't touch a client's brief if they have a plan to sell in 5 years.
Okay.
And I'll be feeling uncomfortable and sad if they've got a plan to sell within 10 years. So ideally, I mean, if it's a home, you're obviously not dealing with capital gains tax issues if you're upgrading. But if it's an investment, you are. You've got your entry costs, which is your stamp duty and establishing your loan. Then you've got your exit costs, which is dealing with the agent fees, the marketing, staging, all of that. And then you've got a tax bill at the end of it. And you've got to ask yourself, what am I getting out of this? Would have I been better off just going into shares? So trading in property is expensive. But if it's a home and there's a clear stepping stone plan, I can forgive a 5 to 10 year tenure. I really don't want to touch someone if it's under 5 years.
Yeah, right. Okay. Yeah, and I guess this feeds right into the philosophy that you got in your book, which is the buy right approach to property investing. So this, and like I said, this is going to be a shift for some people. Go, look, I'm going to get in the market, I'm going to get out, I'm going to take my cash, pay down my loan, or go and buy the next investment property, for example, as well. But what you're saying is buy, hold, and most likely don't sell.
That's right. Buy the right one, hold it for a long, long time, either pay it down and enjoy the proceeds of the rent, or pick the right time to sell when you've got advantageous tax opportunity as well, usually in retirement, get some great advice, and then divert your profits into more liquid asset class. There's no right or wrong. Everybody's journey and strategy, it usually hinges around the debt retirement plan. And as I said, it's no right or wrong. It's got to work for you. It depends on when you got started. If you're fortunate like me and you chose to get started early and you weren't buying properties that were, at today's prices, and my property portfolio went cash flow positive a while ago because I got in so early. Now, if you wait long enough, it will go positive. And so the hard yards are behind me. And now my decision is, it's a tough one, but it's a happy problem to have. Do I hold the properties and enjoy the rents and deal with the maintenance issues and the taxes associated with it? Or do I work out what the capital gains tax bill will be and get into something else? Like I said, nice problem, but that's the kind of investing that I think keeps someone on the right path for a long time with less stress when they're not trading.
Yeah. I'll hear some of the listeners' questions, what's going through their mind. They're like, but Cate, I couldn't have bought a property 20 years ago. I was still in school, right? So when property prices were affordable, whereas median house prices now circa to relative to incomes, to buy a high quality, high caliber, or call it A grade or blue chip, whatever property class that is, the entry costs are much higher. So how do I get in? And I think people have this connection between buy and hold for the long term, with it being a grade or investment, a blue chip type of acquisition. How do I hold that? Because one, it's going to suck up a lot of my cash for a deposit. Two, borrowing capacity gets stunted as well. What is that ability then to scale a portfolio, or do I just hold less properties in my portfolio? And I know your book breaks this down as well.
Yeah, you need to plan it, obviously, and you plan it in conjunction with a great mortgage broker, or if you're savvy enough, a borrowing capacity calculator, because you need to calculate not only what does it look like if I purchase property A, but if I purchase property A, how do I get B? And then how do I get C? So you've got a provision for these, and a lot of people don't think strategically about that. So they target the amazing house in, I'm just exaggerating here, but Melbourne or Sydney, and they think that A grade equals expensive and really strong capital growth to the detriment of the yield, so
Correct.
that your holding costs are extreme. Of course, you'll wipe out your borrowing capacity and be stuck with one good property and nothing else. Sometimes slow and steady wins the race, but you've got to meter out your deposit, and you've also got to meter out your borrowing capacity. And too many people don't understand that the importance of borrowing capacity is so critical. Otherwise, you will be stuck with just one. And might add, you don't need 10 or 20 properties to retire comfortably. If you had 4 or 5 good quality properties, and not necessarily super exy ones, but well thought out, well considered, well targeted properties, you can do okay. And some of the properties that I purchased when I got started, they weren't really expensive properties, and some were in regional towns. And I was just looking at some properties that we got in regional South Australia 20 years ago. And at the time I was excited because one was getting 10% gross rental yield and the other 11, which by anyone's measure is great. And I thought to myself, look, if this value can just keep up with CPI, I'm not going to complain because the return is just there in the rent. Anyway, a snapshot of 20 years later, the capital growth returns on both of those properties have sat between 5.3 and 5.5 year on year. Now, that's not bad. And when you think about what I spent on those properties, it was one was 72,000 and one was 73.5. It could be the other way around, 72.5, 73. It was not a lot of money. I didn't have to work too hard to get those deposits up, and those properties have rewarded me. Obviously, when you're getting lower price properties like that and you've got a few of them, you've got more headaches. And my portfolio is mixed. It's not just little regional properties that can give you headaches. But my point is, you don't need to spend over $1 million to get a good performer.
Thanks very much, Pete. I guess the conversation that you're having, buy, never sell, for example, how does that fly with some people when you're having to break this down? And again, some of these initial frustrations or those, I guess, learning new patterns or behaviors when it comes to this type of paradigm shift. What do you experience, Pete?
Yeah, I mean, there's a Warren Buffett quote for every occasion. So you mentioned the challenge for newer people coming into the market today, and it's the old thing, isn't there? Somebody's sitting in the shade because somebody planted a tree 20 years ago. Well, there is definitely a sense of the best time to buy was then, and the second best time is now. But yeah, I think the idea of buying and never selling is kind of in a sense a Buffettism, isn't it? Our favourite holding period for a high quality compounding asset is forever. And certainly that's been my approach. We've never sold anything, but I think it's not to say there's never a time to sell. I think sometimes, for example, and we might even do this in a couple of years if the market takes off as I'm expecting, because we've got a few units in places like Sydney and Brisbane. If you can redeploy the capital more profitably, or you could sell one property to buy two, and particularly as you get later in the journey, if you want to shift across towards more income producing assets, there can be a time to sell. I just think what we try to articulate in the book is try and buy the best quality asset that you can with the budget that's available. And as Kate mentioned, that partly means looking at the land to asset ratio and try to visualize a property that can compound for you as long as possible. Now, there may be a time to sell depending on your circumstances and as the journey goes along, but to try and buy with that long-term view in mind to begin with is obviously best, because as Kate mentioned, as an investor, if you sell, you might have, let's say, 20% to pay in capital gains tax. Then you've got selling costs, so the agent's going to clip another couple of percent, solicitor fees, and then if you come to buy again, you've got probably 5% to pay in stamp duty and purchase costs. So it's quite inefficient to be buying and selling too much, and that's why Kate says short term is really 5 years or less. So yeah, look, it's not to say there's never a time to sell, but the longer you can own quality assets for, generally, the better it tends to work out for you.
Yeah. I think of this a little bit, and when I was doing some research, Kate, it's like, is it the first, first property, should you be embarrassed about it when you talk that stepping stone? Because it's a bit like your first car.
No.
You get embarrassed by it. And I see all the time, I was like, and Benny and I were together, she's like, you got to sell this property. I'm like, no, you'd never sell your first property. You hold it for as long as forever. And she's like, it's costing you an absolute arm and a leg to maintain this thing. So I wonder, especially for younger Australians that are really that are ambitious, trying to get their foot on the property ladder as well, it's how do we get them thinking quality for long-term buy and hold when they're buying at entry-level prices?
Yes, that's a great question. I love talking about this with first-time buyers, and you should only ever be proud of what you buy. You don't have to love it, and when it's an investment, you're not living in it. You just have to be proud of it.
Yeah.
And the pride should stem from the hard work that you've done to get there, and the fact that you own your own bit of bricks and mortar. I think that's very cool. And let me use my daughter as an example. She is on track to buy something around the $400,000 to $450,000 mark. And if the prices stay still, which, recent past suggests in Melbourne that they will, she's looking at spending about $420,000 to get a boutique, old 60s, maybe 70s apartment that is in a block of perhaps 10 or 12, really well located in terms of proximity to the train and to the local shops and cafes. Nice problem to have. Will that be her forever home? Not at all. And will it make for a good investment? Probably. So that's the kind of train of thought that you need. You've got to get started somewhere. And if you can make sure that your location is good, make sure that your outgoings are predictable and tame. And when I say that, I mean, if you're buying into a strata block, you don't want rising damp or significant brick cracking or any special levies dealing with asbestos. You can imagine all of the things that pop up with old boutique buildings. But when you think about new high-rise buildings, there are so many more. You've got cladding issues, you've got water ingress, they can raise a special levy and you might not have much choice about paying it. And then they take out a loan of, $1 or $2 million and everyone's hit with horrible special levies for the next 5 years. And it makes it a really hard thing to sell as well. They're probably the warning signs that I'd have for people getting started. But as far as a stepping stone, you should never be ashamed. And if anyone dared to laugh at my daughter about what she's looking to do, I'd be saying, well, my dated 70s unit is better than your non-existent property. So you have to start somewhere.
It's a lovely perspective. Thank you very much. Spoken like a proud mother as well, right? So
I am.
Well said. Pete, when we talk about the flavors, I guess you pick your poison when it comes to investing in property, and we'll see it all the time where to try and make, and we talk about this is a long game. So almost the contrarian view to this is I'm going to get in, got a big block, subdivide it, put a granny flat or put a duplexes on it or a triplex, for example. And I can make some pretty good return on that investment, that capital right now. And it's almost like take the sugar hit. I can use that capital to then go into my next project. And it feels like it's a very sexy way to, springboard and ramp up your investment property portfolio. And then there's the, give it a lick of paint, renovations, get it revalued, pull the equity out and keep going as well. So there's a few, iterations of this as well. But you're saying buy and hold, which almost seems maybe a little bit boring in comparison to some of those, getting the fast lane type investment approaches. So how do we temper that with, I guess, people's risk appetites and then most importantly, their strategy as well?
Yeah, well, for sure. For one thing, as you mentioned, if you're buying and holding on to a property, you can still renovate. So in fact, that was a big part of our journey, was to try to buy places where there was work needed, right? So probably the first, 5 properties we bought were in Sydney and London. So you're always working on a tight budget when you're younger to get something that's good enough. So one of the things you can do, and it's probably, I would argue maybe it's a bit harder to do now because there's so many people on the lookout for a renovator, but a lot of what we did was we'd buy somewhere, we'd live in it for a year or two, do the renovation, get it up to a kind of professional standard or something that would appeal to people like us, I guess, young professionals, then rent it out and then move on to the next one. So there's definitely ways you can add value. I suppose back in the day, they used to say for every dollar you spend, you want to try and add $1.50 or $2 of value. So look, it might not supercharge your journey, but you'll get some depreciation on that as well. Now, obviously, as you said, the more enterprising approach would be to buy something to do maybe something more significant than just a renovation. So a lot of what we did was things like repainting, new kitchens, bathrooms, carpets, which is largely cosmetic, and you may be only adding $1.50 or $2 for each dollar spent there, but you can do something a bit bigger. I suppose one of the things to be careful of or be wary of, I've seen a lot of people over the years who've spent an awful lot of time and energy and not really sort of achieved as much as they might have done because they've overrun on subdivisions and development cost, or there's a dispute with a builder, or things go wrong and there's not the contingency, and after paying the transaction cost, they haven't really got as far ahead as they might have done just by a more passive approach. So there's a lot of different ways to do it. I think Kate summed up nicely that there's no right way to do this necessarily, because there's a lot of different ways, and but yeah, I think certainly a lower risk way to think about it can be to buy, renovate and hold, and if you've got a good eye for development, then you can take it a step further. But yeah, sometimes you need to look at the risk adjusted returns and not just the potential returns, I guess.
Yeah, thanks very much.
I think, Aaron, what a lot of people get wrong when they're thinking value add is not putting a value on their own time. So if your desk job, day job is not building related, and then you're tackling a renovation, you're taking time off work, and then you're buying materials, you're not getting trade discounts because you're not a tradie, then you're making mistakes, and so having to get them fixed, and time is inefficient. To Pete's point, you might not be getting $1.50 for every dollar spent. You might be getting 75 cents, and you've got to then ask yourself, what is the point? Now, in this climate with building materials and trade shortages where they're at, there are a lot of people who misunderstand the value that they'll bring to a table as a non-trade skilled person, and they've overcapitalised, and worse still, they've neglected to put a value on their own time. So they've taken annual leave or whatever they've done. They could have been earning a better hourly rate in their day job and paying someone who was more efficient. And that's a very simplistic kind of overview, but I've seen it strike all too often. And the people that do really well with flips and renovations are actually builders.
Yeah.
You see them flipping their own houses, you see them with all of the guys on the job sites, and they're all interspersed, and one day they're at property A and the next time they're at property B, and then they're dashing back to A, putting on the second coat of paint, whatever it might be. They know how to run an efficient model, and too many people misunderstand that. But if you've got a special power, or if you're closely related to someone with a special power, or if you can barter your special powers. I watch my stepson, he's a carpenter, and his mates are chippies and plumbers and sparkies, and they all jump in and help each other, and they know how to run a job and do all of these jobs for cases of beer or whatever it might be. They're the ones that do really well. It's the untrained, untrade skilled people that can overcapitalise and make a mess of it.
It's a good point. There's an old saying, isn't there? You should try and lean into your edge. So if you're an accountant and you're good with numbers, then capitalise on that. If you're in the trades and you've got access to potentially labour and materials at trade costs, and you know how to do a renovation, then lean into that. So yeah, it depends definitely on the skill set that you have, and make the most of what you've got.
Oh, spot on, both of you. And when we talk to clients that are trying to do subdivisions, I'm like, what experience have you got in this? Like, no, I'm not. Like, this is an expensive way to practice. And if you put that channel and energy into your own jobs, I reckon you'd increase your income, or, dial that up, because you're coming out of your active role. So, we have our active day jobs, and you're trying to go into something else, which is an active role. There's no passive income being created here. You're going from one active role to the next. And I think, you're right there, Kate, which is the return on investment. You haven't really broken it down accurately enough. You're kind of looking at gross. You're not looking at net margins. You're looking at gross margins, and and not factoring in your time. And super important.
You also have to look at the time that you haven't got it rented out, and you're not getting tax deductions. All of those things are on costs that you've got to think very carefully about.
Yeah, well said. Perfect. When I kind of looked through the book and looked through I guess, how does someone go about becoming a successful investor? When I say successful, it's not about the quantity, it's about the quality of their portfolio as well. You've got the strategy, you've got their investing style, their approach, their risk appetite, where they are in life, their personality, their access to capital and equity, and then also their borrowing capacity. When you kind of break that all down, and you would be so well trained and diverse in this as well, how do you get someone to go into this mode of property investing that you go, this is a tried and tested pathway, which is a buy and hold, versus that trading mindset as well?
I think when you look at, when you see sort of how wealth and equity is created, there's really three elements to it. And you've touched on all of them there. The first one is leverage. Second one is compound growth. And the third one, unfortunately, there's no substitute for, is time. But if you can get those three components together, the way that compounding works is that you get, it's like the lily pad covering the pond. You know, the biggest gains come at the end, and it takes 29 days to cover half the pond, and then on day 30 it covers the whole pond. And it's that's the hockey stick effect. So I think, look, our brains are not really trained to understand compound growth. We tend to think in a very linear fashion as humans, but if you can combine those three things, you can actually achieve stupendous things through sensible real estate investing. But the third component is time. And I think, there's definitely in the modern world, there's a tendency to look towards get rich quick ideas or something that's going to make me money in the next 6 or 12 months. But yeah, compound growth and time, I guess you do need both of those factors working together. Kate, what do you think?
You've answered that so perfectly, but your question, Aaron, was how do you reprogram someone who thinks that that's the way to go with property? Typically, the people that come to me thinking that that's the way to do it might have done it once and they've had a great gain, and they think it was because of their amazing renovation. And so then I have to segment and apportion what was based on their renovation and what was actually based on capital growth in the time that they held it. And it's usually a really rude surprise. And I had one person that I sat through the exercise, and when we looked at their total build cost, and they were very honest with me, they would have made more money if they didn't touch it.
Yeah, wow.
There used to be a Pommy TV show. I can't remember the name of the show, but the presenter was Sarah Beanie, and they would do this thing. Show. Yeah, I can't remember what it was called, but the basic premise was you would buy somewhere, somebody would renovate it, and she would
Renovation
give her
Rescue.
input. It could be that one. Yeah. And I mean, but basically the same thing used to happen at the end of every episode, because it was in a bull market back at the time. And she'd say, look, this is what you spent, and you've made, let's say, a 28% increase on the property value. But if you just bought the place and done nothing, you'd have got 29. You know, it's like, it would be like a recurring theme every time that the market had actually delivered all of the gains. And because of the cost overruns or the unforeseen issues or the plans changing along the way, quite often the capital wasn't necessarily deployed in the most efficient manner. And obviously you can learn those things as you go along, but yeah, it's surprisingly common.
Overcoming mistakes. So there might be a bit of buyer's remorse. There might be a bit of mismanagement or a strategy, for example, where people have got a portfolio, a property in their portfolio that's holding them back, or they haven't been able to get past one because they bought the wrong property to start with as well. At that point, is your advice, hey, look, sell, start again, for example? Obviously, this is case dependent on each person's scenario, but how does, and the question then comes into, how does someone move past the mistake as well? Because there is probably a huge amount of scar tissue that lingers as well.
Yeah, there is. It's a great one to chat about, and you've got to be prepared to reconcile your portfolio if it's been a disastrous decision. But you've also got to remember that time can heal some issues, not all. And you also have to remember that property is a pretty forgiving asset class. So when I say that, if I look back at any of my 7 out of 10 acquisitions, long before I was a buyer's agent, I'm talking about my own. And if I think, could have I bought something better with the knowledge that I've got now? Of course. But over time, is that property a dud enough to get rid of it? No, it's delivered. And once it's cash flow positive, you've got to ask yourself, what will liquidating this asset do? If it's freeing up capital for you to put into something else, then that's great. But there are quite a few stage gates that you've got to go through before you just go ditching a property, and you should be getting advice. And as far as the collateral damage goes, which is your mindset and your willingness to take an educated risk, again, that's the bit that you need to, really bandage up and look after, and you need to get good advice. And good advice usually comes from, referrals from people that you trust. It might be forums, it might be reviews, it could just be going in with a lot of good questions when you're meeting an advisor. But you can't let a bad property experience burn you, because if you never get back on that horse, then you'll never get the goodness out of what can come from investing in this asset class.
Thanks very much. Pete, your thoughts?
Yes, I think that's one of the hardest things, isn't it? If you've got a real setback, and look, we do see it sometimes. I think one of the most common things you get as a financial or market advisor or property market participant is that somebody will come to you and say, look, I bought this place off the plan in a boom period maybe 6 or 7 years ago. Now it's worth less than I paid for it. What do I do? And I think it's very hard psychologically. As Kate mentioned, time can heal a lot of things in real estate. It's a fairly forgiving asset class. There are some things, though, where you sometimes are just better to cut your losses. I think if you've got issues in terms of maybe structural issues, or if you've got a property that's just going to be a massive drain on your cash flow, sometimes you do need to sort of sell and move on. I mean, look, the right mindset to have is there's no failures, there's only successes and lessons. Of course, that sounds really easy, like a fortune cookie when you read it in a book. It sounds easy. Of course, in the real world, we feel the pain of making mistakes. But I think what would I say to somebody in that situation? I guess I've been working in financial services my entire adult life, I guess, since I left uni. And I don't think I've ever had somebody come to me and said, yeah, everything went perfectly. I didn't make any mistakes and it all worked out great. Like, that's just not how things work in the real world. Life gets in the way. It might be a job loss, relationship breakdown. Often there's an investment that didn't go as envisaged. So I think it's not completely uncommon, but the thing you can really do is take the good bits and be thankful for those things that didn't work out as expected. You need to chalk those up as lessons and try and look ahead, look forward. But it's definitely an easy thing to say and sometimes not quite so easy to do.
Yeah, thanks very much. I appreciate it. And I guess even in the buyer's agency sphere, you're going to have the exact polar opposites of what you're proposing, right? Which is the trading mindset, buying as many as you can when you can, and that scalability as well. So I feel like that's at ends, I guess, competing against what you're saying as well. You probably see this with some industry peers. So how does someone shift that to go, I'm going to buy quality over quantity? Because, I mean, you hear and see it. People go and buy 10 properties in 10 years, for example. Not even that. I think it's a much faster, more accelerated approach that you see, or how to become the top. I mean, we speak about becoming 1% investors as well, but how do we then shift that conversation from quantity to quality?
I think using some projections, having a look on a spreadsheet and asking yourself how many headaches you want to preside over. And that's not to say that cheap properties are headachy, but there's correlation. And if you could do this with 5 good assets and reach financial freedom, or have good choice at the age that you want to have at, that's got to be better than 15 or 20 properties every day of the week. So it's a case of projecting it out. And if you're not able to do that, there are plenty of good operators that offer that service, property planning service, so that you can get visibility and work with some really sensible metrics that are achievable, based on recent history as opposed to lofty targets. I think knowledge is power. So if you can plot it out and have a look at what it looks like, understanding your own ability to borrow, that's critical. You need to know what your borrowing capacity looks like. Then you can plan out what is the least number of properties that I could buy that will give me the least headaches and help me get to my end goal. And if I could do that again, I would. At the time that I started investing, I was on a much lower income. I was a graduate chemist and the money that I was earning was pretty low, and I had to buy cash flow. And I don't regret any of that. But, if I could project my life and have my way again, of course it would look a little bit different. And to Pete's point, life gets in the way, but you've got to get your foot on the ladder and start somewhere.
Yeah, thanks very much.
Yeah, I mean, I've done quite a lot of portfolio reviews over the years, and look, a lot of people did go down that strategy when lending conditions were different. I think sometimes buying some of the properties at the cheapest end of the market just to buy quantity over quality. I mean, sometimes you can find just one repair or one special levy. It can wipe out years of capital gain. So that's one issue. And quite often what we find when you review those portfolios, it's a bit like the old 80-20 rule. You find that maybe two properties have done all of the heavy lifting and a lot of the properties have not really contributed that much. But yeah, look, not dissimilarly like Cate, as somebody who's been self-employed or an entrepreneur for the past 13, 14 years or something. There's been various periods where we would have loved to have borrowed more and bought more expensive properties, but the bank's not quite so interested or on the same page. And I guess then you try to find ways to keep moving forward. And sometimes that does involve buying sort of lower grade or cheaper properties than you might otherwise want to buy. I think sometimes you do find in investing, not just in property, just in general, that a higher yield, not always, but sometimes that either involves some level of extra risk or complexity, or as Cate mentioned before, it might simply be time. If you think about, let's say if you're buying a business for $1 million and it says the net profit's 200K, and you think, well, it looks good on paper, but really the 200K is a job, and it's sometimes the same with like an Airbnb property. The yield might be 12%, but somebody's got to wash the sheets. Somebody's got to take the bookings, the wear and tear. So the 12%, it represents a bit of sweat, time and energy. So yeah, look, there's definitely sometimes where you might buy a cheaper asset or a lower quality asset just to keep moving forward. But if you can achieve more with less, as Cate mentioned, you'll probably have fewer headaches over the long run.
Thanks so much. Cate, just before you mentioned about property plans, where can people kind of get access to something like that, or is there resources available online that people can tap into?
There are some people that offer that as that's their core business activity. So, for example, my fellow podcaster Dave Johnson at Property Planning Australia does it. Yeah. A qualified property investment advisor, so QPIA, who has those credentials from PIPA, which is our Property Investment Professionals of Australia organisation, that they can put together plans as well. But when you're looking at someone like me who could do a plan, it won't be anywhere near as sophisticated and as chunky and meaty as someone like Dave, who does this for a living and has all of the really great software at their fingertips. Beautiful. And I think you've got to be really careful about who you're relying on for a plan. You've got to make sure that there's no vested interest in them to sell you multiple properties. And I sometimes think getting that separate advice, a good quality mortgage broker is worth their weight in gold, because they're the ones that have visibility to the data and to your specific borrowing capacity, and they can put these inputs in. And, I would say that the way that I built my plan years ago, when I took 2 weeks off work and sat there and crunched numbers and built, forecasts and plans the hard way. And the most useful tool I had was a borrowing capacity calculator.
Yeah. I mean, that would be for a lot of people, like I'll go on a holiday, they'd research the hell out of their holiday, right, for 2 weeks, and you're taking 2 weeks off to work on what to set yourself up for the long game. What's that saying? If I had 6 hours to cut down a tree, I'd spend the first 4 hours, sharpening the saw. And that's exactly to what you've just done there, which is slow down to be able to speed up, not speed up in a literal sense, but accelerate your wealth journey. And for a lot of people, I don't even think they'd spend a year working on their wealth plan, let alone 2 weeks locked down to then go, I'm going to spend this time nutting out my financial planning strategy as well. Well, kudos to you. Yeah, beautiful. Where can we get the book?
Ooh. Pete says this really well.
Yeah.
Do you think, Pete? It's like 2 all beef patty special sauce that is cheap.
I was thinking, what do I normally say? Well, basically any good bookstores, as they say. Yeah. But yeah, for sure, check out the airport stores. You can get it there. You can go to Dimmicks. You can go to Amazon. You can go straight to our publisher at Major Street.
Beautiful.
But pretty much anywhere you can buy a book, I guess. Google it, The Buy Right Approach to Property Investing. You'll find a way.
I love it. And to support it, we're going to give away a copy of the book. So if you've loved... we'll get a copy. We'll give that away as well. So if you've loved what Cate and Pete are putting out there, drop us a DM. We'll go fastest fingers first and let us know what you loved about this episode, what you got out of it as well. And we'll send a copy of the book to a winner's way as well. Cate and Pete, I want to say thank you so much for your time, for your energy, and also the amount of effort that's gone into putting this into a book, which I know it's going to resonate with a lot of people and hopefully get them into the right headspace around successfully investing in property. Well done.
Thanks so much for having us on the show, Aaron.
Appreciate it.
Pleasure. Thanks, Aaron.
Thanks, gang. If you love this episode, we always say share it with a friend, someone that's on the journey with you as well. We say get that ripple effect getting bigger and stronger in our community as well. So love to hear your feedback on this episode. Until next time, take care.